Welcome to episode 16. This is a discussion of Chapter 16 of UAE Crypto Litigation, available at www.uaecryptolitigation.com.
It's great to be diving into this one today.
Okay, let's unpack this.
Yeah.
I want you, the listener, to imagine making a massive, really complex commercial agreement.
Right.
But you do it at a coffee shop, and you don't sign a single piece of paper.
Just relying entirely on a trail of WhatsApp messages.
Exactly. A casual text thread is the only thing you have to prove that these massive financial obligations even exist.
It sounds incredibly risky, but it is one of the most pressing legal questions in modern digital asset speculation today.
Yeah, I mean, if that deal goes bad, does an emoji or a quick sounds good actually establish a binding multi-million-dollar liability?
Well, objectively speaking, that is the exact legal problem we are framing today. Can informal electronic communications establish that kind of liability in the complete absence of a formal written contract?
Right.
And our mission in this deep dive is to explore exactly how the UAE's sophisticated legal and regulatory frameworks answer this question.
So we're going to look at how the judiciary handles this practically.
Yes, and then we'll examine the proactive regulations, and finally, how you can actually design contracts to avoid the issue entirely.
I love it. Because, you'd assume high-stakes finance requires, stacks of notarized documents.
You'd think so, yeah.
But to see how this actually works in reality, let's look at a 2024 Dubai Court of First Instance Judgment.
A really fascinating and determinative judgment.
Set the stage for us. What actually happened in this dispute?
So, objectively summarizing the facts here, we have an investor who provided a significant initial cash sum to a defendant.
Okay, a large cash transfer.
Right, and this was based on a promised percentage-based return derived from digital currency investments.
Specifically Bitcoin, if I remember the text correctly.
Yes, specifically Bitcoin. And, after what the investor described as initial success, things escalated.
As they usually do in these cases.
Exactly.
Yeah.
Further large cash infusions were made over a period of months, but eventually it culminated in a multi-million-dollar dispute.
Wow. And they had no formal contract.
None. The investor claimed the defendant acknowledged this massive debt and literally promised to return it entirely through text messages.
Wait, really? Just texts?
Just text. And naturally, the defendant countered by citing a lack of capacity and a complete lack of authentic proof.
Yeah, I mean, I'd probably do the same. Anyone can fake a screenshot, right?
That is the exact challenge the court had to navigate.
Here's where it gets really interesting. I saw in the analysis that the court used a very specific procedural approach.
They did.
Can you explain the court's decision to appoint a Tripartite Expert Committee? Why 3 experts?
Well, because modern digital disputes are incredibly multifaceted. The court appointed specialists in digital currency, accounting, and IT.
Okay, so they cover all the bases.
Precisely. The accounting expert traces the fiat currency. The digital currency expert looks at the blockchain. And the IT specialist focuses on the electronic communications themselves. And this committee's findings became the absolute cornerstone of the judgment.
So what did the IT expert actually find when they looked at the WhatsApp messages?
The technical expert verified that the defendant promised multiple times to send the massive sum via WhatsApp.
Oh, wow. So they authenticated the actual chat logs.
It did. And crucially, the expert noted that the defendant never denied the entitlement in those chats.
I see.
Nor did the defendant prove to the committee that any repayment had actually occurred.
So they have the technical proof of the conversation.
Yeah.
But how does that translate into binding law?
This is where the judiciary applied some really foundational legal principles, specifically the 2022 Law of Evidence.
Okay, the 2022 law. How does that treat a WhatsApp message?
It's very clear. Through the objective application of Articles 55 and 57, the law establishes that electronic evidence has the exact same force as written evidence.
So a digital message is treated like ink on paper.
Legally, yes. But the really critical part here, the part that addresses your earlier point about faking screenshots, is Article 58.
Right. What does Article 58 do?
It essentially places the burden of proof squarely on the party, claiming that the electronic messages are invalid.
Wait, so effectively, because the defendant couldn't prove the digital evidence was invalid, the law presumes those texts carry the weight of a signed contract.
That is absolutely correct. The court bridged those technical expert findings with these legal standards.
That's a massive shift in how you'd normally think about burden of proof.
It is. And based on that, the court found the defendant liable for the principal amount.
Just the principal.
No, plus a legal interest rate. And that interest rate decision was based on established 2021 Dubai Court of Cassation precedent,
Okay.
which runs from the date of the claim until full settlement.
That is fascinating. So the courts are fully equipped to enforce these informal obligations using modern evidence laws.
Completely equipped, yes.
But, going through a massive trial with 3 experts sounds exhausting. So what does this all mean for a licensed operator today?
Well, that's the perfect pivot, right? Moving from the judicial resolution of a messy dispute to the proactive, highly structured regulatory environment.
Yeah, because ideally you want to prevent this ambiguity before it even starts.
Exactly. And the UAE's current mature framework for virtual asset service providers, or VASPS, is designed to do just that.
Let's talk about that VASP framework under the VARA Compliance and Risk Rulebook 2025.
It's an incredibly stringent set of requirements. First, you have the client money rules.
And what do those mandate?
They require absolute asset segregation. Client funds must be placed into designated accounts at UAE third-party banks.
So there's absolutely no commingling of funds.
None whatsoever. The VASP cannot mix client money with their own operating capital.
Okay, that makes sense for cash. But what about the actual crypto?
That falls under the client virtual assets rules. The virtual assets have to sit in separate wallets for each individual client.
So no giant pool of everyone's Bitcoin.
Right. And there is an absolute prohibition on rehypothecation.
Meaning they can't lend out your crypto to make a side profit.
Exactly. Plus, the framework incorporates SCA Annex 7/2023, which outlines strict technical protection measures for the cryptographic keys themselves.
That's a very robust safety net.
It really is.
But I want to connect this back to our court case for a second. That whole dispute started because of a promised percentage return.
Yes, the promised crypto yield.
Right. How do current regulations handle a licensed operator making those kinds of promises over a text message?
Under Viara's broker-dealer and advisory rulebooks, guaranteeing returns on volatile assets triggers strict client suitability assessments.
So they have to actually vet the investor first.
They do, and the rules explicitly prohibit any misleading promises or deceptive forecasts.
So you can't just text someone, hey, I guarantee a 20% return next month.
Absolutely not. Furthermore, the actual execution of trades requires what's called best execution.
Which means
It ensures the VASP is securing favorable pricing for the client, not just routing it in a way that benefits the broker.
Okay, I see. So if you think about it, we're upgrading from a trust me text message to basically an impenetrable, perfectly lit digital vault with a glass door.
That is a very accurate analogy. The regulatory requirements even include mandatory immutable audit trails.
Oh, so everything is tracked permanently.
Every transaction.
Mhm.
And they have to provide monthly reporting statements to the client, which must be kept for 8 years.
Wow, 8 years. So the WhatsApp liability issue basically vanishes in a properly regulated VASP environment.
Functionally, yes.
But let's say you're a sophisticated commercial party, maybe an institutional investor.
Right.
How do you structurally design your private contracts to just completely neutralize this risk from day one?
That brings us to practical, forward-looking commercial application. The author provides some really clear guidance on robust transactional design here.
What's the foundation of that design?
It starts with making the written agreement the absolute sole source of truth. And you achieve this through standard but vital clauses like the entire agreement and no oral modification clauses.
Sure, just basic contract law saying if it's not in here, it doesn't count.
Exactly. But in the digital asset space, they take it a step further. They introduce a critical clause known as the Communications and Non-Reliance Protocol.
Okay, the communications protocol. What does that actually do in practice?
It preemptively strips all legal authority from informal channels.
Like text messaging.
Like text messaging, WhatsApp, casual emails, all of it. It mandates that only designated interfaces or authorized emails can trigger binding actions.
Wait, is the goal here to basically make human conversation legally irrelevant to the actual execution of the transaction?
That is exactly the goal. It confirms a rigid, multi-stage electronic procedure for everything.
So how does a trade actually happen then if you can't talk to your broker?
It happens through formal orders submitted via an API.
Okay, an API.
Yes, which then generates binding confirmations. And at the end of the day, you rely on daily settlement summaries.
That sounds completely automated.
It is. It removes the human element of interpretation.
And what about finality? In crypto, things can get weird with blockchain delays. How does a contract handle that?
Settlement finality is defined in very strict technical terms within the contract.
Give me an example of that.
Well, it might require a specific number of blockchain confirmations before a trade is considered legally final.
Ah, so it's tied directly to the network's math, not a human saying deal.
Precisely. But there is one final ultimate safeguard discussed in the text that we have to mention.
Oh, what is that?
The Tripartite Account Control Agreement.
A three-party agreement. How does that work?
It's a structural mechanism that allows the client to issue a notice of sole control.
Notice of sole control. That sounds serious.
It is. It legally categorizes the client's assets as protected financial assets.
Okay.
And if that notice is issued, it ensures the client can unilaterally reclaim their assets from the custodian completely without the service provider's intervention.
So if things go south, the investor can just hit a button, lock out the operator, and take their money back legally.
That's the practical effect, yes. It is the ultimate risk mitigation tool.
That is incredibly smart structuring. So to briefly summarize our key takeaways for you today, we started by looking at the immense evidentiary power of digital communications under UAE law.
Right.
If you make a promise on WhatsApp, modern evidence laws and tripartite expert committees can and will enforce it.
Exactly.
But then we saw how the rigorous safeguards of the VASP regulatory regime are built to prevent that ambiguity entirely.
Through strict asset segregation and immutable audit trails.
Yeah. And finally, we covered the absolute necessity of bulletproof contractual architecture like those communications protocols to really manage your risk.
To bridge today's analysis with where we are heading next, here is the author's perspective on what this means for the broader legal landscape. This judgment provides a definitive statement on the power of digital evidence, confirming that clear and uncontested admissions in WhatsApp messages can be sufficient to establish a multi-million-dollar debt in the absence of a formal contract. The court looked past the informal medium to the substantive content of the communications, enforcing the defendant's own promises against him. While this case turned on using digital messages to prove an existing obligation, a party's conduct after an investment has failed can also create new legal duties. The next judgment explores the doctrine of novation, examining a scenario where the issuance of a new check following investment losses was interpreted by the court as the creation of a new, personal, and unconditional debt, legally superseding the original at-risk investment mandate.
That brings us to the end of our discussion on Chapter 16. This chapter's structure is the standard methodology used throughout the book.
Authored by Mahmoud Abuwassel, and drawing on analysis from over 100 judgments, UAE Crypto Litigation serves as an indispensable resource for those in the digital asset industry.
To read the full analysis for this chapter and to explore the complete 7-part life cycle of a commercial dispute covered in the book, please visit www.uaecryptolitigation.com.
The discussion in this podcast is for educational and informational purposes only and does not constitute professional advice or any other professional relationship. Please consult with a qualified professional for advice tailored to your specific situation.